Welcome to The Great Resignation, a special series of Let's Talk About It, brought to you by Stearns Financial Group and dedicated to discussing the most relevant financial and economic news impacting the investment market. In this edition, the conversation focuses on a term coined to describe the unprecedented numbers of people intentionally leaving the workforce provoked by COVID-19. It's called the Great Resignation. What is it? What factors are causing it? Is it about to end, or are we looking at a lasting trend? And most importantly, how does it impact you? Whether you're a boss, an employee, a consumer, or an investor. If you like what you hear, please be sure to follow, comment, and share. Now, here are your hosts, Dax Dixon and Lindsay Brock.
And welcome back to another edition of Let's Talk About It. And this is a special edition. It's episode 2 of The Great Resignation. On a previous podcast, we discussed what's going on within the U.S. economy and how many people have either retired or transitioned to new jobs within the economy over the past year or two. And a lot of that has been pandemic fueled. However, there are some key considerations. So in this edition, in episode 2, we want to just discuss what those key considerations are from a financial perspective when you're deciding to transition careers or even go into retirement. So without further ado, I will join my team here. We have Holly Madasser, JT, and Lindsay. How's everybody doing today?
Great.
Well, Dax.
Good. Yeah, so last time I opened up with a few nicknames. I dove into my head and I couldn't find a single good nickname for any of you for this podcast. So I am sorry that we don't have the creative nicknames. But
It's Dax. I like my nickname. You can call me Boss Lady anytime.
Well, welcome, Boss Lady. So I think in the last episode, we bifurcated the market, the labor market, that is. There are those that are migrating to new positions and those that are retiring within the broader Great Resignation. So let's focus on that first subset of people first, and the people that are actually moving jobs. So Lindsay, I know that you and I work with a number of our younger clients. So when we're thinking about maybe quitting a job and either transitioning careers, whether you're in your 30s or 40s during that, key lifespan there, what are some of the key considerations that you'll have when moving jobs?
Well, I think if you're considering this migration, the key that you're probably thinking about is you're worth more elsewhere. And that could be anywhere, right? In a different spot in your career, a different career entirely, or maybe just a different firm or employer. But the problem is it's hard to know your worth. You think you might be worth more, but how do you know? So you really have to consider what there is out there. And we have a lot of trouble with this lack of transparency in our country, unfortunately. And unless you have a leader or an employer who's really, really transparent with you and has your best interest at heart, you're not going to know exactly what you're worth. So I think that what's been really nice is during this great migration, we've had employees finding out that they have more negotiation power right now. And so when all of these industries are having a little bit more of a lack of labor, but an excess of demand, they are able to test that boundary of what you're worth. I think that's one of my biggest ideas there.
Yeah.
I add to that just a little bit, and I'm speaking because I have 2 kids that are in that age group. I think that working from home too has somewhat dissolved some of the working relationships that keep you at the job. So you're not going into the office every day. You're not hanging out with your buddies at lunch every day. And so the focus becomes more the job itself. And if there was dissatisfaction with parts of the job that was somewhat compensated by the social aspects, you may be more willing to jump ship all of a sudden. And so I think it's kind of loosened that bond a little bit with existing employers during the pandemic as people have worked remotely more.
Yeah, I think that's a good point. I think, if you dig into the data, a lot of people are kind of moving out of service-related work. And I think you hit on it. The work from home is, some people actually look at that as an additional benefit. And so if you're able to leave maybe a lower paying service job to do something that's more work from home, you kind of win on both sides of that. A lot more flexible schedule, you're at work, but you can immediately transition into the home life. So with that being said, if you're thinking about that, what are some of the financial considerations beyond maybe what you will be paid? Let's say if you have a month or two sabbatical between your job, what should you consider before quitting one job to start the other?
Well, I think you definitely want to examine, and I want to hear more about what Holly and JT have to say about this, but you really want to make sure that you have something lined up next. And that doesn't necessarily mean the next job. It just means, what are you going to do next? And are you investigating, what your options are? Are you looking at the benefits that are maybe not even financial? A lot of companies now are offering things like discounted cell phone plans or fertility treatments or student loan repayment plans. And there's so much out there that you can use to negotiate. So what is it that you really want to look for? Is it work from home?
Yeah, that would be my hypothesis, that a lot of these reinventions are much more about other job attributes and not strictly the compensation. Clearly, that's an important consideration, and labor generally has a lot more power in this market to negotiate on those things. And so hopefully those conversations are being had more frequently. But my expectation would be a lot of these folks are really seeking, how do I get on a different track, a different trajectory that maybe reflects my expectations for that long-term future. We certainly know that probably that kind of 25 to 35 timeframe is pretty critical in defining what sort of trajectory you're going to be on long term. So if you can make a rung or two advancement on that ladder, so to speak, it's going to have huge dividends over that long term. But you do need to figure out in that time frame, what are the key attributes that are going to be not only enriching me but fulfilling me, and make sure that that track is fully fleshed out.
Yeah, and to that end, I think geography is a big part of it. A lot of times in that age group, you're forced to move to the big city to get the job and this, that, and the other. But all of a sudden, if you can work remotely and you can live someplace at the beach where it's much less expensive to live there, and you get to wake up to the, sound of the ocean, and you're still getting the same comp, that's a hard thing to compete with.
And I know this will be a later segment of our series when we talk about kind of work employer implications or business implications, but we've heard several anecdotes of sort of talent-based industries where they are really struggling to compete because some of their workers that were here locally are now employed by firms in San Francisco or New York, and they're used to paying at a very different price point. So, you may be able to take advantage of that and, kind of back to my earlier point, jump that rung or two on the ladder, depending on your desire to really advance. But that has trade-offs too. Are you going to be comfortable working long-term for a remote entity, if you will?
And I want to jump in one more. We've touched on this idea of work-life balance without actually really saying those words, but that's been something forever, right? But it's historically, I feel like, meant more, can you go into the office at 8 a.m., do your job until 5 p.m., and then leave, turn it off so that you can become a family member. But I think that's becoming more intertwined. Now, instead of work-life balance, it's more, are you working and enjoying it? And are you enjoying your life while you're working? And, we can discuss whether that's dangerous from working from home at all hours, or are you just actually looking for something that you enjoy and is fulfilling that you happen to get paid for?
Yeah. Well, one thing I wanted to note, JT, some things you said, kind of the world is flat, right? And it's flattening every day. The classic Thomas Friedman novel from back in the day, where he talked about the global competition for talent. And I think kind of as you transition into a work from home atmosphere, or what's becoming more and more accepted, that race for talent even escalates even more, right? It intensifies, because you're right. You used to be, like say a data scientist, you had to move to the Bay Area, work in Silicon Valley. If you can do that in the Rust Belt, make the same thing, lower cost of living, maybe be closer to family, it may make sense at that point. So the one thing I did want to note as well is, during the pandemic, there's a buildup of cash for a lot of people because of stimulus checks who may be kind of at middle income tier. So I think that's given them a little bit more freedom and runway to make career decisions so they can stay out of work for a few months and really make the right decision for them. And hopefully long-term, JT, like you were saying, they move a rung or two up and really transition careers to be more productive and happy with what they do. So just to transition now to just, JT, do you have something there?
Well, just that there's always this shaking out process, right? The pendulum tends to swing a little too far. And candidly, pre this most recent COVID recession, we may have had, forgive me, too many coffee shops and yoga studios and sort of hobby or passion businesses. And maybe we're seeing that take place too, as we have a lot of folks jumping out with the aspiration to change career, adapt into something that's more fulfilling, or move from service into the work from home environment. And a lot of that will stick, but there's going to be a shakeout time. I don't know if that's a year or 2 years from now, where folks revert back to a little more traditional career pathing model. It's not going to go all the way back, and that's a good thing. I mean, it reflects this more flexible hybrid sort of work environment. But we're not all going to be able to pursue those dreams in the full expression, if you will.
Wow, that's JT popping dream bubbles over here.
And that's a really good idea that I hadn't really thought of, is the amount of people who are now starting their own business because they want to be their own boss. Those businesses are not all going to survive for one reason or another, and that's okay.
That's part of the great creative and great destructive process of our society and our capitalism.
Mm-hmm.
Yep. So transitioning to the great resignation, the other side of it is actual retirements, whether that's full stop retirements or whether that's ramped down retirements. I know we've had several clients kind of enter into a consulting or part-time work with their employers as they kind of ramp off. That's a solution we see a lot, but others have come to this conclusion. I think JT, you said balance sheets are doing well for a lot of people in kind of the retirement age. So what specifically did you mean by that on episode 1 of the Great Resignation?
Well, I guess it's similar to that theme I was just hitting on. You know, we saw this pre-.com. We had a lot of folks who had really strong net worth because of their investment success over that window of time, who decided this was the time to pull the parachute and jump out of the workforce. We're seeing some of that this time as well. I mean, it's been a remarkably rewarding really period from 2009 through the present. On average, the total returns have probably been above their long-term historical trend. You know, certainly folks who are more oriented to the higher growth segments over the last year or two, the bounce back from COVID has been very enriching. So folks are making decisions about that gross number on their balance sheet and feeling very flush and able to make that kind of retirement decision. And I think we've seen a lot of our financial plans. In fact, I was speaking with a client yesterday who, you know, they unfortunately were in an industry that was really badly hurt by the shutdowns of COVID and hasn't come back. So they had expected to be working in a part-time way for another few years, and they really haven't been able to do that. Fortunately, in our plan, we were able to show them that, you know, he doesn't have to force his way back in a way he's uncomfortable with, and he's still going to be all right. Now, again, we're basing that off of the best projections in several scenarios, but I want to make sure folks are assessing not just peak wealth, but long-term trajectory of wealth as they make these decisions.
Yeah, I think that's a good point. I know, Holly, you and I have both sat in a number of client meetings, or I've sat in meetings with you over the past year or two where we do have clients either right on the precipice who've been talking about it for 3 to 5 years, or even clients who have transitioned. And, you know, I was joking with Lindsay, sometimes there's this huge mental leap when you jump from thinking about I've just put money into my retirement savings for 30 or 40 years, and now I'm going to completely reverse that. And just the simple act of, do I get a paycheck or things like that can be a huge mental leap for clients. So, you know, in the 2 or 3 years leading up to that date, what are some of the key considerations for clients who may be thinking about pulling the trigger?
Well, I think a couple of things. I think doing a financial plan and projecting out your cash flows obviously is huge. I mean, you've got to know what your burn rate is, and you've got to make sure that you can afford to do it. And to JT's point.
So Holly, real quick, what do you mean by burn rate?
I'm sorry, I'm using industry jargon. But how much you're spending every month. So, and Dax, you know this, we have clients who have, you know, what we would consider nominal wealth, who live very comfortably. We've got other clients who are at the top of the food chain, but their spending is so high that we literally worry that they're going to outlive their assets. So, you know, wealth is a relative term, and it doesn't really matter what you have. It's kind of with living within your means is the key component there. And so I think doing a financial plan, projecting out your cash flows, ensuring that what you have will cover your desired lifestyle is very important. And in terms of market tanking and retiring at all-time highs, I mean, that's true with or without COVID, right? That's true in any environment. We call that in the industry succession risk, which is you retire at the very moment that the stock market kind of tanks, and now you're suddenly withdrawing assets and selling assets when the market is down. And so the way that we counsel clients on that issue is to make sure that you have 1 or 2 years worth of cash flush on the sidelines so that you can fund your retirement without having to do that, without having to sell low. And so that's a way to kind of hedge against that. Also to make sure that your risk tolerance is appropriate. You don't want to be too aggressively invested, especially in volatile markets. So scaling back that risk tolerance is very important when you go from, accumulation mode, let's call it, to withdrawal mode. We want to make sure we always have some defensive assets that we can draw from to fund your lifestyle.
Sure. And so I wanted to hit on one thing, because I think this is very important when you're talking about how much you spend a month relative to how much you have or how much you make, those sort of things. So as a retiree, we, in the industry, we often hear the 4% rule, like you can withdraw 4%. So if you have for every $1 million, you effectively can pull out $40,000. So I know, JT, you've been through the ups and downs of the market, the tech boom, the 2008 global financial crisis, the COVID crash, and a number of other things. And you've seen different types of clients who spend more or less relative to their net worth, so to speak. So how valid would you say the 4% rule is, or do you look at more of kind of a distribution around there depending upon the client and the situation?
Well, it's certainly a distribution. That is a great rule of thumb, but it is just that, right? And so you don't want to take that to the bank, as it were. But it has been very reliable, and it's been remarkable as we've worked with clients over the last 20 years to see that those who have stayed within that sort of rough frame of reference have succeeded quite well. Now, the research would say, and you think about that 4%, there's this concept of guardrails around that, and the idea that when the market goes down, you want to be able to adjust your spending to compensate. When the market's going up, you might be able to expand that withdrawal rate and take a little bit more. And so, I think that there's always that range. You want to think about, and I liked Holly's description of knowing what your burn rate, your cash flow are. I think being able to think about the categories there, and particularly if you're thinking about an early retirement or retirement that you need to leave something that's maybe not fulfilling or is, causing health problems or whatever it is. So you're trying to do that earlier. I think being able to segment off some of your spending and thinking about that, critical, essential, core spending, the important spending, and then the nice to have. And that's that nice to have piece at the top, maybe those splurges that when the market has done well, as it has over the recent years, your withdrawal rate can expand to cover more of those things. But if we have the converse, and not that we're predicting this at all, but if you were to see a more protracted bear market, we might be willing to give up some of those nice to have pieces to make sure we manage that withdrawal rate.
Yeah, kind of stated otherwise, 4% is a good guardrail, but some years you might be living off of 3%, some years 5 or 6, but you kind of want to kind of segment your spending where your fixed spending, your fixed cost, kind of your home price, your cars, your transportation, feeding yourself, those sort of things. I think that's where the emergency fund that Holly talked about really comes into play. You want to make sure that you can fill those gaps if needed, because maybe your 3-week long vacation to Europe might not be able to take it with the markets down, so to speak. Is that what you're saying, JT?
Very much so. And again, all of our clients have diversified portfolios. So even if they don't have 2 years of true cash, they're going to have parts of their portfolio that are more risk tolerant and are going to be places you could in case of emergency, break glass if you had to.
Sure.
But I think one of the really interesting ones is those clients, we talk about risk tolerance a lot about the portfolio design, but there's a risk tolerance here as well, right? I mean, what is your risk tolerance for withdrawal rate and retirement date, right? If you wanted to move that lever a little bit earlier and a little bit more expensive, what's your tolerance for that? And again, that planning process can test that out over time. I think some of the most interesting, engaging, and ultimately satisfying conversations for us are when we have really unique client patterns. Maybe there's someone who has a health risk come up, and they really want to be able to have a chapter of life that starts earlier in retirement. Maybe there's a big difference between client age or stage. And so helping them sort out, that rule of thumb has to have a lot of adjustment or customization for those unique fact patterns.
Yeah, it's very nuanced. Sorry to interrupt, Dax, but I was just going to say so much of it depends on your age. And the irony is that the younger you are when you retire, the healthier you generally are, the more active you generally are, the more you want to do the cruise around the world with your kids and grandkids. That's expensive. And yet, when you get older, that's generally the most expensive time of life, that last 6 months, healthcare costs and whatnot. So, asking clients to moderate when they're younger so that they don't outlive their assets is a bit tough, because most people don't want to, save all the money for the end to pay for their healthcare when they are young and healthy and want to be able to do things. So we just need to be able, and in our plans, we generally do factor in a nice, healthy vacation every year. The kinds of things that bring people joy, we want to make sure that you can do that when you're younger. But obviously your withdrawal rate, if you're 80 years old, is going to be higher than it is if you're 50, right?
I want to actually bring up a little bit more on this spending, but more your personality type. And I think this is important when we consider women. Holly, we all work with women, but Holly, I know primarily a lot of your clients are women. And so, excuse the phrase, I hate it, but almost every woman who is managing a portfolio, considering retirement, is concerned with bag lady syndrome, or where, you might end up with little to no assets and you're kind of left with your hands empty. So how can you manage that, especially for women? But I mean, men also could have that fear.
Yeah, I mean, I hate using that. I hate perpetuating that stereotype, but I have in women's defense, you can't blame them, right? Most women have lower Social Security. They made less in their careers. They have lower savings. And unlike most men, they're going to die alone, responsible for their own health care. They don't have a wife who's tending to them at home, so they're going to have to pay for it. And so that's a big wild card. What's it going to cost?
And Holly, when you say they're going to die alone, that's specifically because on average, women live longer, correct?
Yeah,
so typically
and actually, the statistic is 95% of women die alone. They die in charge of their own family's assets. So it's kind of a daunting proposition to know that, to plan for the unknown. How long am I going to live? As my mother always used to say, which depressed me to no end, but she would say, don't worry, honey, everything's going to go wrong with you, but you're not going to die. So this is what happens to women. You get the Alzheimer's, you get the bad knee, you get this, you have to have assisted living, you have to pay for all of that. So we counsel a lot of our women clients toward long-term care insurance, if it makes sense, depending on their asset level. But the reason women are worried about becoming bag ladies is they don't know how long they're going to live. And they don't have any help generally. I know my kids aren't going to move from New York to take care of me, right? So I'm going to have to pay for that. And I think that's starting out with lower levels of assets, being less likely to invest in markets due to fear, and also just a longer life expectancy. It makes women fearful of spending too much generally.
Well, and I really hope that there's a tremendous role that we can have in offering that education. And again, this is typecasting a bit, but too often women haven't been afforded the same opportunity to really be educated about their finances, about how they last, about how the process of a diversified portfolio allows things to hold up through thick and thin. So again, I think being as proactive and being engaged with your finances as early as possible. And again, we really appreciate and enjoy the opportunities to work with both couples and single women to ramp up that process and to instill that confidence. I hope that clients listen to this more often than not. Their experience is that we're encouraging them to find ways to do more of that live for today, knowing that they have resources and ways to fit that puzzle piece together to handle the live for tomorrow as things transpire.
Yeah. I find actually that the financial plan is freeing for most people. You know, I say things to them like, tell me, if money were no object, how would you live? And if that's spending $10,000 a year on vacation and taking art classes, we budget that in. If we can get the plan to work, you no longer have to feel guilty every time you spend money on a tube of paint, or every time you go to the beach for the weekend. It alleviates people, kind of provides a clear line what you can and can't do. If you stay within these parameters, you're not going to outlive your assets, generally speaking.
And I don't want to overplay this recent example, but it's the one that I, again, went through with a client yesterday, where not only were they able to be okay turning off work earlier than they expected, but we ran a scenario that allowed them to see that they'd be okay spending an additional $2,000 a month if they chose to over the next 10 years to do exactly the things Holly's talking about, to make sure that they get this chapter of life to be a full one on the live for today side of the ledger.
So now I just want to transition specifically to, considerations if you're retiring earlier, because there's some very technical considerations that, such as, your full retirement age for Social Security, for example, that you need to think about when, let's say, if you retire in your late 50s, early 60s. So Lindsay, when you're mapping out an early retirement scenario on the financial planning side, what are the kind of the key checkpoints if you're going to retire early? You're obviously going to have a much longer extended retirement versus someone who retires in their mid 60s. And so what are you looking for and discussing with your clients?
Yeah, that's a great point. And a lot of people just think, do I have enough money to pull that trigger a little bit early? But there's a lot of nuances in there that you should think about. Like you mentioned Social Security, and you don't have to take Social Security once you retire. So you can take it as early as 62, but it's going to be reduced from your full retirement age, which is around 67. It's going to be reduced each year, or really each month earlier that you take it. And if you delay it until your full retirement age, or even beyond up to age 70, you can receive up to 8% per year in that benefit. And if you think you have longevity on your side, that's something you're really going to want to consider. But another key component that we're factoring into plans is if you retire before Medicare age, which is 65, you're going to probably need a private health plan. If something happens and you need health care, you need that to exist. And those private health care costs are quite expensive between those years of when you retire at 55 to when you might be able to use Medicare at 65.
So, Lindsay, I agree with everything you're saying, but I want to throw in a plug for the Encore career. And so if you are unhappy in your job, please don't stay there because of your health insurance. Get a different kind of job. And so we see that all the time with our clients. We literally have a physician who she's at the top of her game, and all she wants to do is work at a flower shop. Fine. You still get your health benefits. You can make this work. And so I think one of the beauties of the role that we play in clients' life is empowering the life that they want. It's not just financial, it's not just economic, it's how do you want to spend your days on this earth? And if you're doing something you don't like, let us help you figure out a way to make a transition. So just because you're resigning from one job, or let's say retiring from one career, doesn't mean that you can't do something completely different. And I think I'm living proof of that. I've had multiple careers in my life, and each one has been the right thing at the right time, at the right phase of my life. You don't have to keep doing the same thing you did when you were 20, when you're 70, right? Mm-hmm. And so we change. We're dynamic creatures. And if you're a creative personality type, you get bored doing the same thing. So that's okay too.
I think we've used the phrase that it may be a great reinvention as much as it is a great resignation, right? And so, yeah, having that encore career. But I think back to Lindsay's points that there in that decade from age 60 to age 70, there are a lot of levers that you have the opportunity to assess when and how to pull them. And depending on your facts and circumstances, it may be exactly reversed from your neighbor who has slightly different facts and circumstances. I mean, we think about, maybe, as Lindsay said, in probably, in my estimation, the majority of cases, it's really powerful and probably beneficial to be able to defer that Social Security as deep as possible to age 70. But there are a number of cases, and we have other advisors in our firm who are very expert in assessing these Social Security cases. But if you have a need for drawing pre-age 70 and all of your assets are IRA based, it may actually work better to start that Social Security at full retirement age or early to take care of some of those core expenses, so you don't have to be triggering as high a tax burden to draw out the funds from your retirement plans. So again, that's just where a lot of good nuance needs to be sorted out to help you accomplish those goals as soon as possible.
Yeah, we've actually done scenarios for clients to that point, JT, where it's true you get an 8% raise a year, but people don't think about the fact that you're actually giving up the principal during that period, right? So if you could have, let's say, withdrawn $30,000 a year in Social Security and you defer for 8 years, that's, $240,000 that you've given up in income. Sometimes that takes till your mid 80s before you even break even. And so you have to think about that, not just the bump that you get when it starts, right?
Yeah, that's that key thing to have in mind, is what's that crossover point? And ultimately, we're all betting on our own longevity. Are we going to beat the actuarial table or not? If you're going to live beyond age 88 or 89, you're going to have more total money come in from Social Security. But if that crimps your ability to live the life you imagine between age 64 and 72, that's not a trade-off you necessarily need to make.
Yeah, I think the only other main financial consideration you really should think about is just if you're looking at a really early retirement, and you want to count on your IRA that you've maybe concentrated on investing over time, you cannot take withdrawals before age 59 and a half without a substantial penalty. So, there's the quintessential CEO who's done so well, and he's 56 years, or she is 56 years old, and she wants to retire, and then is surprised that she can't even tap into her IRA assets without being hit by that penalty. So just remember that having a bit of balance on your balance sheet between retirement assets and non-retirement assets could help you.
And to that point, Lindsay, that age from when you retire until you have to start taking Social Security is a wonderful time to do Roth conversions if you can. So it's a way to effectively transition from a pre-tax situation to a post-tax situation with minimal tax impact. And of course, that will grow over time if you do a Roth conversion tax-free. And so it's a wonderful tool if you can access it.
And we do the portfolio diversification, we love to have some tax diversification. And I think it's easy in a lot of areas of life to get really silo focused on something that seems to be empirically better, like the tax deferral. But I think being able to think in the long frame and consider, if you want to be able to use some of these levers and options about early retirement, you want to be thinking ahead of time about building assets that aren't tax deferred, so that you can have that you can use them when you might need them in there.
Mm-hmm. I was probably going to jump to the next topic that I think you were going to jump to, but I think the last thing that I really want a retired or a potential retiree to consider is not financial at all. It's more, it's what we're going to probably be talking about in a later episode, but it's what are you going to be doing with your life? And so if you're retiring, whether on the later end, or especially on the earlier end, you mentioned that you're going to have 30, 40, 50 years to fill your time. And that can be pretty daunting. So making sure that you have that purpose. We'll talk about that more further in another webcast, but I wanted to bring up that topic so we could converse a little bit about it.
Yeah, like my number one things I say to people, my clients who are considering this, is that recreation is not intellectual stimulation. And there's a big difference. So we've had clients who, the CEO types, I can't wait till I'm retired. I'm going to play golf. I'm going to travel. I'm going to this, I'm going to that. And 2 years of that. And, you need a reason to get out of bed all of a sudden. And so having that higher purpose or passion that you're pursuing for, 3 decades is a long time to just play golf, in other words. And so I think that's very important, and goes to one of our core values at Stearns is, we want to help empower your purposeful life, which is what does get you out of that every day. Because the money is just a means to an end. The goal is to have a purposeful, happy, fulfilling life. And that's our number one goal as advisors.
Well said. And, I've enjoyed the conversation with the three of you. And what I think is especially important is kind of the reason why you have some people, as JT noted, the reason why you have some people thinking about retiring earlier is because there have been good financial markets over the past couple of years that have increased their asset levels and maybe enabled them to do so. And as we've discussed some of those key considerations as they transition, we talked about all different types of financial levers that a client can pull to think about how they can insulate themselves from market risk, and when to do the various things like engage Social Security, things like that, without directly talking about they are going to experience some volatility within the marketplace throughout their retirement. But with a good financial plan and good forethought, you can kind of limit how that impacts your lifestyle over those 20, 30, 40 years of retirement. So with that, I want to thank each and every one of you for joining me here today to discuss the Great Resignation and some of those key planning points that people need to think about. Our next episode, we're going to focus specifically on how the pandemic and the Great Resignation have impacted women within the workforce. So with that, I'll say goodbye to each of you and hope you take care.
Thanks so much.
Yeah.
Stearns Financial Group is an investment management firm with offices in Chapel Hill and Greensboro, North Carolina. Securities are offered through Hightower Securities, LLC, member FINRA, SIPC. Hightower Advisors, LLC is an SEC-registered investment advisor. Refer to brokercheck.finra.org for more information. This podcast is copyrighted and all rights reserved. The content of this podcast is for information only and not intended to serve as financial, legal, medical, or any other form of professional advice.